interpret the latest comments. So I think that an intervention could come fairly soon if the markets try to test the officials' resolve, and 152 could well become that new line in the sand. And I guess the need for that is pretty significant, given that I guess Japanese corporates, Japanese lifers, real money investors will need to know at what level they could start repatriating money back home. And if indeed the MOF or the BOJ continue to delay that, that could become self-fulfilling, and then it could push it high or lower still, essentially across the board. So from that point of view, indeed, I think an intervention should come fairly soon, should the markets test the officials' resolve.
The question is, though, to what degree does the physical intervention even work? Because it might work for a short amount of time, might slow the trend, but it doesn't reverse the trend, does it?
Well, last time around it worked quite well. It worked for actually 6 months back in 2022 when they intervened. It lasted for actually more than 6 months. So from that point of view, I guess from the officials' point of view, what really matters, as you said, is really how much of an impact really any intervention could have. I think there are at least a couple of reasons to expect that an intervention could have stronger impact this time around than before. Trend reversal, potentially, depending on the currency we're talking about. But if you think about it, I mean, you've mentioned the BOJ, they are on their way towards the exit. They're normalizing policy very gradually. That said, that is happening in the context where all other central banks in the G10 space are moving in the opposite direction. That should mean that over time, the yen's huge rate disadvantage will ultimately dwindle. And the second point is, from a purely FX point of view, we now have, for the first time in a while, a credible alternative to shorting the yen, especially for FX carry investors that are looking to fund those trades. That alternative is the Swiss franc. I mean, if you look at Swiss yen, we're at 3-month low. And the point is, or I guess I should say, the hope of the Japanese officials would be that the FX investors will turn their attention to another funding currency, and that currency could well be the Swiss franc. So with all that in mind, I think that an intervention could come, maybe series of interventions if needed, because I think from the official standpoint, an intervention is likely to have a somewhat stronger impact.
Was it just bad timing for the Japanese? I mean, we saw a little bit of disappointment that ZIRP was really going to stick around for a bit, zero interest rate policy, rather than moving much more positive. But then we quickly got away with the US data and then the US narrative. And what we've seen really has been a story of dollar strength that's impacted all currencies. So was it just bad timing in a way for the Japanese? They didn't get more for their bang for their buck, so to speak. It's
an excellent point in the sense that the 2022 intervention succeeded partly because the whole dollar complex shifted. It's when the euro dollar was coming from 95 lows. And indeed, actually in March 2023, we had the banking crisis in the US, which ushered in those aggressive rate cut expectations. I mean, the dollar, is a major driver of dollar yen at the moment. There is no denying that. So I guess the best that the Japanese officials will be hoping for is just to keep it stable for as long as possible, meaning until the Fed starts cutting rates, which we expect will be around June, July time. So it's like not that long of a period of time. But I guess what they're really hoping to achieve is really just to disrupt the appeal of the yen as a funding currency there, and indeed give the investors sort of a pause for thought. Okay, maybe shorting the yen is not the right trade. Maybe you should look elsewhere. Whether that's going to trigger a trend reversal, I think yes, that'll be the case. But predominantly, as I was saying, Swiss yen, euro yen, we're bearish there as well. Dollar yen, going against the dollar at the moment really may take some time really to see that really coming to fruition.
Yes, and
it's a difficult, but that's why, nevertheless, I think from the officials' point of view, I think they have to draw that line in the sand, because a lot depends on that. A lot of the hedging behavior of the Japanese corporates, a lot of the repatriation decisions by the Japanese real investors, they need to know at what level the yen is weak enough.
Around hedging, I was asking the boss of Nissan earlier in the week about whether he was concerned about a rising yen from here, and he sort of looked a little bit shocked. I think because the question is probably thinking, gosh, more about weakness as well. It was like every direction we could possibly have could be an issue. So what does a Japanese corporate do at this point if they think that down the track we're going into a story of rising yen, but in the meantime there's fairly widespread weakness happening in the currency?
Well, I guess from their point of view, obviously, it's really a matter of at what point do I bring money back home and pay wages or whatnot. So it's really about the level, at what level the yen is weak enough. And really, that's about it. So at the moment, they're delaying any hedging activity, right? So fact of the matter being that the weaker the yen, the better off they are, right? So that's a boost to their profits. And this is why the signaling properties of any intervention essentially are much more important than the actual the impact of that on the markets, and not only drawing the line in the sand, but also making a stand. Okay, this is where we stand. We're not going to let it slip any further. And to your point about the Japanese yen, I mean, increasingly over the years, the Japanese, our clients as well, have been increasingly looking at different crosses than dollar yen. I mean, CNH, CNY yen was actually potentially the more important of those crosses. And even that is really trading at record highs, well, not record highs, but fairly multi-year highs for the yuan versus the yen. The yen is very cheap versus the Chinese renminbi. So from that point of view, I think, I guess the bigger concern is whether we're going to see further depreciation rather than whether the yen will be appreciating too aggressively for comfort. Yeah.
Unfortunately, we have to leave it there. We'd love to keep on talking about this and all the other currencies that are out there. But Valentin, thank you for joining us today. Enjoy your long Easter break.
Oh, thank you.
Valentin Marinov, Managing Director and Global Head of G10 FX and U.K Research with Credit Agricole. Now, to find out why Standard Chartered believes intervention could come any day now, head over to cnbc.com.
It felt like it was a very busy number of months, I've got to say, and it was very much a busy quarter on the markets. Arabile running us through the numbers and how it looked. There was a lot of upside surprises.
Oh, man, I don't know if we've got enough time to really cover all the ups and downs that really happened across the first quarter of 2024, right? We saw that closing into 2023, seeing some positive numbers as well. So that rally sparked straight into this year. And it does come from that dovish tilt that we saw then out of the Fed, where they spoke about those rate cuts coming through in 2024. The market at some point presumed that there'd be at least 150 basis points of cuts out of the United States. That wasn't to be necessarily, and you can see now that the market has tapered that down to around 3 cuts, but pretty much a dovish stance across all the central banks, and even one of them having cut thus far this year. Let's kick things off out of Asia, though. We saw that historic hike in interest rates out of Japan, and that was quite significant to that market, but still only edging out of negative territory then for those negative interest rates, right? So there you see a big move then for the Nikkei. Japanese stocks moving past that 40,000 point mark, a 20% gain. That's a big gain then out of that Asian market picture that we have been seeing. Again, the rate story very important here. The tech counters have also been very interesting to look at. Surprisingly, the Hang Seng, however, which has been a big mover this month, has certainly been moving as well, but down it went 3% lower on the quarterly basis. Out of Europe then, let's get what the theme could certainly be out of this one. You're seeing gains across the board, but only 2.5 or so out of the FTSE 100. 10% though for the DAX, and really those top 3 were the ones we looked at for record territory moves. The CAC 40 as well as the DAX managed to move higher then because of those. Now, very significantly, for the FTSE 100, the leader there was Rolls-Royce, up 41%. CAC 40, Safran. DAX, Rheinmetall. So what's the theme? Well, you're seeing defense companies actually move higher across the first 3 months of this year. Again, that increased spending on defense has been very interesting. Here's your stocks gainers and losers across this quarter then. And again, it'll give you that clear theme then across that defense spending. There's that 78% uptick then for Rheinmetall, the German defense company there. On the other side of this, however, HelloFresh is facing a few concerns and a few worries while it tries to turn that business around. That food delivery business is still facing a few issues. Ocado as well, a few issues with Marks & Spencer there. That's brought that stock down nearly 40% in the quarter. On to the United States we go then. And this has been, of course, some massive movements that we have seen across here. Dow components, well, healthcare stocks actually enjoyed the biggest uptick across the first quarter, followed by industrials as well as basic materials. So a gain of around 10% then for the S&P 500. That's its best quarterly gain then since 2019. So significant. It had risen around 13% at that stage then back in 2019. The NASDAQ also more than 9% higher. Here are your gainers and losers with regards to that then. You're seeing some of the tech counters in this space, but significantly Disney, which has needed that uptick then, turning things around a little bit there with a near 34% uptick across the quarter. Even American Express on the banking side managing to move a lot higher there. On the downside, here you go then. Apple stuttering a little bit there, nearly 10% weaker, with Intel also following on that negativity. Of course, Boeing was expected to go down following that fuselage blowout then. Even the Mag 7, very interestingly, Apple and Tesla at the bottom of those counters. Karen.
Thank you very much, Arabile. Amazon has announced plans to invest a further $2.75 billion in AI startup Anthropic, its largest external investment in history. The company, which is widely regarded as a frontrunner in generative AI, received $1.25 billion from Amazon in September as it seeks to compete with OpenAI and ChatGPT. Coming up on the show, cocoa prices soar with Easter just around the corner. Mandy and I are going to be joined by Sylvia and a golden guest, an annual guest that seems to hop onto the set to visit us every year.
It's very fluffy.
CNBC. Live ambitiously.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Kelly Evans, The Exchange, CNBC.
From Beijing, where we've just learned that China is targeting around 5% GDP growth this year.
5% is not going to be easy. They worry about the labor market weakness, the old model of a property infra-driven economy. We have to rethink it.
What is going to be very important is how the private sector responds to what it's hearing from the NPC and from Beijing. And I think at this stage, the private sector is not getting very much.
Inflation may rise, but setting a target of 3% that at least show the intention to generate a moderate rise of the price level.
Chinese consumers don't seem to have a problem with the amount of money they have, it's the amount of confidence they have.
It is impossible to replace China as a supply chain center. For the long term, I think the investors still have confidence, but in the short term, I don't see a point for them to rush back into China.
The government seems to be much more benign where they are. They recognize the difficulties, but not as serious as the investors.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
It's breakfast hour for most people across Europe. I gotta say, I'm feeling a little bit hungry. How about you?
I'm always hungry. You know, it could be any time of day and I could eat.
We have a special treat. It's this time of year, and thank you to Daniel very much for bringing this beautiful bunny in. Because as we talk about Easter this weekend, chocolate is at the forefront of many minds. The key ingredient is cocoa. It soared in price this year's disease and extreme weather hamper production. Sylvia, I've got to say, many fixated on Nvidia stock, but if you're looking for gains, cocoa has outpriced Nvidia this year.
Absolutely. And for those of you planning your Easter egg hunt this year, it might be costing you a little bit more compared to last year. But let me show you why. Essentially, we have been seeing cocoa prices skyrocketing really over the last 12 months. They're up by more than 200%. And the bulk of the increase has been happening at the start of of this year. There are several reasons behind this, but overall the big reason is the fact that we're seeing the biggest deficit in terms of supply of cocoa over the last 60 years. Crops have been seeing diseases. You have trees at their maximum yield capacity. The weather conditions as well have also impacted production. And let's also not forget that some of the farmers in some producing countries such as the Ivory Coast, they've also been looking at more profitable crops such as rubber. Now, what has this really meant for some of the chocolatiers? I want to show you some of the price action over the last 12 months. In essence, these companies have been looking at promotions at different types of Easter eggs as a way to counter for that fact that they are also paying more for cocoa. I just want to leave you with this comment that the CEO of Hershey, he did tell our colleagues stateside that it is a dynamic market, they're used to volatility in prices, but nonetheless they're keeping a close eye on what's happening in the cocoa market.
We're going to chat this one later, but have you noticed, Sylvia, how like it's not just hiking prices that, you know, Easter eggs are more expensive this year. You also notice shrinkflation, right? You know, you pick up an Easter egg and you can almost crush it with your fingers just by holding it because it's so thin. Anyway, coming up, we'll talk about Lloyds set to release their full year results. Don't go away.
This is the game changer seat. Look, it even comes with binoculars.
Watch the markets open. Brought to you by Emirates.
CNBC. Live ambitiously.
Ambition to me is about doing better. In my 25 years at CNBC, the one thing that resonated with me was that ambition has to go beyond oneself. It's about creating that platform, laying out the foundation, rolling out the runway where others can succeed. Ambition is only successful when it benefits communities, the next generation. It creates jobs and impacts livelihoods for the better.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate.
There's a huge hype around AI and what that cycle is going to bring.
Ultimately, it's the infrastructure players that continue to win out in this sort of AI boom we are seeing.
AI is quite possibly the defining technology of this decade, maybe even of our generation.
This is an AI revolution, and it's really, I think AI is everywhere, but it's not only happening in the data center, it's happening on devices.
AI is really a critical part on our product development, but it also goes into our product.
Our goal is to democratize supercomputing for everyone and give access to them to improve business productivity, to get better insights from the data.
This is not about artificially, creating solutions. It's not about replacing people. It's about augmenting capabilities, competences, skills.
It is the year of AI, and it's ironic. This conference for almost a decade was all about 5G, and now this year it's the AI conference.
Tyler Matheson, Kelly Evans, Power Lunch, CNBC.
Welcome to the second hour of Squawk Box. Here are your headlines today. US equities hit a record high ahead of key inflation data as a top Fed official waters down expectations for a rate cut anytime soon.
I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation.
Lloyd's underwriting profit more than doubles in 2023 to just under £6 billion, with total profit before tax surging more than £10 billion. We'll go through the numbers with the chairman, Bruce Carnegie-Brown, in a few minutes' time.
UBS cuts the negative goodwill from its rescue of Credit Suisse, leading to a hit of more than $1 billion to 2023's net profit. This is as the lender warns it might not be able to realise all the expected gains. Dutch Prime Minister Mark Rutte downplays trade tensions in a high-stakes Beijing bilateral, telling Chinese President Xi Jinping that chip restrictions are not targeted.
They are never aimed at one country specific. That we always try to make sure that the impact is limited, is not impacting the supply chain.
The yen holding near its lowest level since 1990, with markets on high alert for any BOJ intervention. That's after authorities hold an emergency meeting in Tokyo.
It might have felt as though we had some slippage in the UK late last year, and that's been confirmed in the data today, that the official figures as they're published show that the British economy entered a recession in the second half of last year. Looking at the final Q4 GDP, minus 0.2% year over year versus the preliminary estimate that was exactly the same. A Reuters poll thought it would be the slippage of 0.2%. When it comes to the final quarter over quarter, minus 0.3%, also bang in line with the preliminary estimate. So confirmation of that slippage in the economy. And it is exactly that growth story that sets the scene for the central bank here, for the Bank of England, as to just how long it can wait in terms of those interest rate cuts. Very different scenarios. We talk about resilient growth in the United States, which has given the Fed more time as they talk about rowing back on the time frame for those rate cuts. And when it is the commentary that we've heard so far from the Bank of England, it has been from Andrew Bailey that it's not unreasonable to expect that there will be some rate cuts this year. A little bit of pushback though from Haskell, somewhat of a hawk, thinking that still there is some way off when it comes to those rate cuts. A bit of a similar narrative to the hawks over at the Fed, but as I point out, conditions are a little bit different here when it comes to growth.
I mean, it's certainly a general thematic, isn't it, pushing back against market expectations for cuts at a number of central banks. Let's take a look at what's going on with the German economy, Karen. You've got February retail sales worse than expected. So month on month down 1.9%, whereas the forecast was for a 0.3% gain. So that's a lot worse than expected. Year on year down 2.7%. The consensus forecast, according to Reuters, was only for a drop of 0.8%. And I find this really interesting for an economy that's essentially flirting with recession, right? You've got the DAX, the German benchmark stock index at a record high, and I think it's up about 10% year to date. So it's gone gangbusters so far this year.
Yeah, no surprise, though. I think the German retail, very much a reflection of that German economy, that there's been still pressures with the energy story, the industrial competitiveness of Germany. We've heard from so many German CEOs talking about the system being broken for them, that they want somewhat of a reset, easier regulation, more support. And I think that's coming through, that downbeat spirit really coming through to the retail side as well. I'm going to push on and take a look at Thames Water. This has been on the agenda. There's been wrangling in the backdrop trying to ensure the survival of what is a key utility here in the UK, the water that has been very much at the forefront of shareholder crunch talks. Yesterday, shareholders were looking at preparing to come up with a pledge to inject funds rather into the company that would secure its survival. So the latest crossing this morning is that conditions of a support letter from July last year have not yet been satisfied. This is a funding update to the markets. First, 500 million of new equity that had been anticipated will not be provided by Thames Water's shareholders by the 31st of March of this year. So disappointment on this front. Discussions with Ofwat and other stakeholders are ongoing. Thames Water says it intends to pursue all options to secure required equity investment from new or existing shareholders. Thames Water has liquidity of about £2.4 billion of cash and available committed facilities as at the end of last month. Just by way of background here, for those who have not been following the story, if you think about the major shareholders, a university's superannuation scheme, China's sovereign wealth fund, some of the shareholders here, but it could become easily a political issue, an election issue. There were reports this week about the record numbers of E. coli in the Thames, thanks to leakage from water utility companies. So I think there are concerns about just the way it's been managed, let alone the debt situation, the funding problems.
And it serves about a quarter of Britain's population, doesn't it? And employs about 7,000 people. So we're not talking small fry here, but apparently sort of in the lead up to this decision, a source close to some of the investors reportedly said that this decision to water down the financial commitment is not irreversible and could still be changed, reportedly, if the financial profile of a future investment improved. So we will, of course, be watching that.
Let's push on to numbers. And Lloyds has reported its strongest underwriting profit since 2007, posting £5.9 billion for the year, up from £2.6 billion in 2022. The London-based insurer also reported a strong rebound in pre-tax profit to £10.7 billion after reporting a loss in the previous year. Bruce Carnegie-Brown, Chairman of Lloyds, joins us now. Bruce, thank you very much for joining us. It has been very much a story of tailwinds for the industry, premiums rising, better conditions. Just talk us through the numbers that you've posted today as a result of those conditions.
Well, good morning. Yes, indeed, a strong performance from the marketplace with revenues up 12%, about 7% of that accounted for by price and 4% accounted by volume. And then, of course, the benefits coming through now of higher interest rates on the substantial amounts of cash that we hold to pay claims. But I would also point out that we've been remediating our portfolio over a number of years, and we're now benefiting from greater underwriting disciplines. So all of those have contributed to a very strong performance.
I want to bring up the solvency levels here. Market-wide solvency coverage ratio, 207%, up from 181% year prior. How normal are these figures? Is this just a high water level?
Well, they're flattered in part by interest rates, for instance, and they can be quite volatile. But the key message really is that we need to have sufficient capital to pay a growing number of claims coming from a broader range of issues globally. And financial stability is a key tenet of honouring our promise to pay our claims.
Bruce, Mandy jumping in here. High premiums and rising premiums has become quite a political hot potato in many parts of the world, indeed leading some people to even have to drop their insurance if they can't afford it anymore. What considerations do you have in terms of deciding whether or not those premiums will continue to rise, and is that your expectation that they will keep on going higher?
Well, a substantial contributor to rising prices has been inflation, of course. So we're seeing our claims inflated as the cost of replacement increases dramatically. But it's also important that the industry returns its cost of capital. And this hasn't happened really on average over the last 10 years. So this is really the first year where the industry is beginning to make a decent return on its capital. And that return is incredibly important to attract new capital to support risk-taking. We are seeing the level of price rises flattening off. We're not seeing them decline at this point, but we expect pricing to be reasonably stable through 2024.
Is there a situation or a scenario where you would in the future see those premium rises coming down as inflation around the world also seems to be coming down?
Well, certainly it's a very competitive industry and over time has been characterized largely by very competitive insurance premiums. One of the other factors to observe, of course, is the heightened level of claims going on from all manner of risks in the marketplace. And this is one of the things that is causing pricing to remain at these levels.
Bruce, I'm sure you've been tracking the unfortunate events out of Baltimore this week, the Francis Scott Key Bridge. But when it comes to the impact on your industry, Barclays has tallied up a number of around $3 billion, saying Lloyd's of London market is most exposed. What's your reaction to that, to the likely exposure?
Well, first thoughts, of course, are for the tragedy around the loss of lives and the families affected. But as you rightly suggest, we're beginning to deploy resources in anticipation of this being a very substantial claim for the industry and for the Lloyd's market. It's going to take some time for the complexity of the situation to unravel. So very early days to call a number. I don't at this point anticipate that it's outside our realistic disaster scenario planning. It feels like a very substantial loss, potentially the largest ever marine insured loss, but not outside parameters that we plan for.
That is interesting, Bruce, because I think from the outside and looking at the events unfolding, it seemed unusual for any spectator to see such key infrastructure brought down. Can you comment on that context? Because I think for many of us, it just took us by surprise.
Well, accidents happen, and that's what insurance is for. I think it's the second-order impacts that become substantial in this claim. There's very obviously a claim around the ship, its cargo, the bridge. But beyond that, of course, a lot of business is going to be interrupted. Supply chains are going to be interrupted by ships that are both trapped inside the port and, of course, ships that were trying to gain access to the port that no longer can. And those second-order effects will take some time to work through.
We've just been talking about the price of cocoa at a record high, Bruce, and partly because of extreme weather in the countries that produce cocoa. This is becoming a more common theme, isn't it? Climate change risk. How is that factoring into your business, and how do you expect it to impact you in the next few years?
Well, we are experiencing greater frequency and severity of these kinds of events, and we believe they are connected to climate change. 25% of our capital at Lloyd's supports natural catastrophe risk events. And I think industry commentators have suggested that in 2023 there were more than $100 billion of insured natural catastrophe events. And I think from memory, that's about the 6th year in the last 10 where insured natural catastrophe claims have exceeded $100 billion. So you're right to identify this as a significant issue. We believe we have the capital and the expertise to continue to underwrite these events. But it is important that we build more resilience into our economies. And so we spend a lot more time with governments trying to ensure that risks that used to be unexpected and are becoming expected are properly addressed by government in investing in infrastructure to protect our customers, but more importantly, the citizens out there from these kinds of impacts.
Bruce, I want to bring up one of your strategic priorities, and that's digitisation. Just looking at the commentary around this in your report, the cost-efficient insurance marketplace, creating that better, faster, cheaper. AI has implications for all sectors. Your industry creating such a strong digital platform to begin with and using a lot of data in recent years to price insurance. How does generative AI change the nature of what you've already been doing?
Well, there are two sides to the issue. The first, as you are identifying, is around the opportunity it provides for us to use data more efficiently to create more bespoke plans and covers for our customers. And we're already adopting certainly algorithmic technology, and that leads into AI technology in responding to the demands of customers. It also presents, of course, opportunity and challenge around the underwriting side of the balance sheet. We would expect generative AI to create a lot more risks around the issue of security. We're seeing the level of cyber attack, of course, increase year over year, and as generative AI is adopted, those risks will only become greater. So we're trying to develop the right kinds of products to respond to that as well. I mean, my bank, I called my bank the other day and they recognized my voice and passed me straight through security. I'm not sure I was entirely comforted by that.
You can certainly highlight challenges on security there, Bruce. I want to ask you very quickly about consolidation too, because the market's closely been watching developments around Direct Line and AGS. What do you make of consolidation at this point in the cycle, and what does it do to the overall industry?
Well, we would certainly expect to see more consolidation at this point in the cycle. That's been more evidence actually in the broker community than in the underwriter community to this point. But I think consolidation, the benefits of consolidation are really that it allows businesses to write at greater scale in terms of the underwriting capacity they have for absorbing loss and for providing big lines of insurance to our biggest customers. The risk is always that consolidation also reduces competitiveness, and I'm sure the authorities will be on the lookout for that.
Thank you so much for joining us. It's been an interesting conversation. Bruce Carnegie-Brown, the chairman of Lloyd's. Well, many Western markets are closed tomorrow when we'll get the latest look at the Fed's preferred PCE gauge of inflation, with LSEG data indicating a slight uptick in the reading for February. It is expected to come in at 2.5% higher on the year. That is versus January's 2.4% figure. That is only half a percentage point above the Fed's target of 2%, but way down from the peak of 6.8% that was hit in June 2022. Money markets have settled on a probability of around 2/3 that the Fed will cut its rates at its June meeting. That's according to the CME's Fed Watch tool. But not everyone on the FOMC sees rates coming down in the near future. Fed Governor Christopher Waller said in a speech Wednesday that the central bank should push back the timing of a cut after February's CPI data showed an uptick on the month.
In the absence of an unexpected and material deterioration in the real economy, I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation.
Coming up on the show, we're going to break down full-year earnings with Enquest CEO Amjad Bseisu. We'll be right back.
CNBC. Live ambitiously. Kelly Evans, The Exchange, CNBC.
Think of Switzerland and you might think of fine cheese, luxury chocolate and snow-capped mountains. But you may also think of money. Switzerland has 1 billionaire for every 80,000 people, making it the third most dense billionaire population in the world. Only Luxembourg and Hong Kong have a higher proportion of individuals with a net worth of at least 10 figures.
Do you feel like you know any billionaires?
I personally know quite many billionaires, yes, and millionaires, yes.
I do not know any billionaires, no. Plenty of millionaires, but no billionaires.
No, I don't. I don't. I wish I did, but I really don't.
Swiss residents are also among the richest in the world, with a mean net worth of almost $700,000, ahead of the US and Hong Kong. That makes the country stand out on several key wealth metrics. So what makes Switzerland such an attractive place for the uber wealthy?
I landed where I am today through a long journey that started in investment banking. I put in 7 years in investment banking to really build a foundation, the foundation that has carried me to my role now as a news anchor at CNBC. The best career advice I was ever given was to talk to people. If you want something, if you want to move around the place that you work, move jobs, change careers, talk to people and put your ambition out there. And more often than not, you'll find people who are willing to help.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solving problems, you've got to be more diverse.
And LGBTQ rights and our acceptance are on the line all over the world.
We have something to bring to the table for the solution that we can find together in this fragmented world. And music is always at the center of it.
Real lives, real stories, only on CNBC.
UK energy firm Enquest has beaten on the top line, reporting its full-year revenue of $1.5 billion. Let's bring in Amjad Bseisu, the CEO of Enquest, joining us today, live in studio. Thank you so much for joining us today, Amjad.
Thank you for having me here.
Thank you. Well, let's run through the numbers here. 2023, you saw a lot of debt reduction. You also took out a lot of expenditures. 2024, you say, is now going to be about the growth pivot. Yes. How are we going to achieve that?
So we had a good year, a very solid year. We had 300 million of cash flow, 825 million of EBITDA. Our realized price was around $82 a barrel. We also held the cost, which is great. Our operating costs were slightly down, about 4% to $20 a barrel. So we've now had several years where the prices are high. We've had tax, obviously we had a very unstable tax regime in the UK. which caused our tax rates to go up and our tax expenditure.
It has been stable, just not in your favour, to be fair. I mean, they haven't changed it again, have they?
Well, they've just changed it a few weeks ago. They've added another year for the energy profits levy.
Yes.
So instead of that being ending in 28, it's gone to 29. So it continues to be slightly challenging for sure. However, I think we're committed to the UK, and we're going to increase our both our asset base and our organic and inorganic asset base. And we continue to invest significantly in the UK. So I think that's given really our tax asset. We have a very large tax asset in terms of credits, about $2 billion at the end of the year. We get another $1.5 billion next year, 2025. So we have a very large tax asset, which really gives us the pivot for growth. We've reduced our debt now to our net debt to EBITDA is 0.6, which is very, very healthy. Our debt's also matures in 2027, end of 27 mostly. So I think this is the time for us to grow. And again, we're looking to both organic and inorganic growth in using our tax asset.
You've noted that 2024 also will see a further reduction in future emissions, and yet it's quite a fine line, isn't it, between trying to prioritise growth but also trying to decarbonise. How are you managing that balance, and how difficult is it for you to decarbonise an incredibly carbon intensive sector?
Yeah, no, so the assets we take are carbon heavy when we take them, but we have reduced our emissions very significantly by 41% since 2018. We are also committed to investing to reduce by 2040 to net zero, which is a commitment we've made last year. In Sullom Voe, for example, we're investing almost £100 million in reducing the facility size, which will also take the flare out and reducing emissions by more than 90%. So we're continuing to move forward, and it's extremely important. I think it's important to recognize, actually, I think COP28 was quite a watershed event, and Dr. Sultan Jaber did an excellent job at putting together really a framework to move forward. The industry is committed. I mean, we've had, as you know, we've had almost 40% of all producers, 50 companies, sign up to reduce emissions to zero by 2050. And 30 of those are NOCs. So I think the industry is committed, and I think we are very committed as EnQuest in the UK to reduce our emissions.
Can I come back to that UK windfall tax? Because when it was introduced, the oil price was at a much higher level. I mean, 120 plus at its highest, well over 100. But obviously prices have been well and truly down below that level since then, and even this year averaging around the 80 to 85 mark. Are you surprised that the tax has stuck around for so long in that context?
I think it's reduced the investment and the continuing production in the UK. The production is down from 4.5 million barrels in 2000, but even more exasperated over the last couple of years. This last year is down 20%. We're producing 1.3 million barrels a day, quite significantly down. But more importantly, the investment cadence has gone down very significantly. If you look at 13 and 14, and this is OE UK data, we were investing about 18 to 20 billion in 10 years ago. Last year we invested 4 billion, and that's not adjusting for inflation. So the amount of fields coming on are much less. We want to put more gas fields on. The big gas field that was put on was Rosebank. The commitment was there. But really that one field just replaces 1 year's worth of volumes. And for the last 4 years, we haven't at all replaced the investments in terms of the volumes that we're producing in the UK.
I mean, that tax was a headline number, a headline impact for you last year, and obviously you're still feeling the effects. So if we look at the political backdrop, and there is a big suggestion we may see a change of government, would a Labour government be any more friendly for your business?
Well, I mean, I think governments need to be supportive of local industry. I think there's 220,000 jobs in the industry, very highly paying jobs. There's quite a bit of union pressure, I think, in the industry to maintain these jobs. We will have 90% of these jobs transition to new energy jobs, in my view. We just need time. And it's actually the ability to have positive cash flow and the tax rates to be low enough to enable us to invest that's very important. I mean, our tax rate last year is 107%. Our competitors' tax rates, our colleagues' tax rates are also between 95 and 110%. So it's a very high tax rate for the industry, and that debilitates the amount of money that can be invested. More importantly, in new energy and in the transition.
You've alluded to geopolitics in the numbers today. Where do you think we're at? Because for most of the start of the year, there was a widespread commentary that we don't have a lot of geopolitical premium in the price. Do you think that remains the case today and for the rest of this year?
I think it's changed over the last few months. I think with the Red Sea issues, with the with the instability, I think, in the Middle East, with the Russian, with the problems with Ukraine and Russia, and hitting the refinery in Russia, which taken 900,000 off the table, at least temporarily. It's I think we have a premium. It's probably a few dollars a barrel now. The other thing that's taking place is there's the 15% of the traffic that used to go through the Red Sea is not going through traffic through the Red Sea, and there was a lot of oil transport through the Red Sea. And that longer route probably adds 100 million barrels of inventory on the water. So that also has an impact on tightening supplies. The key, though, is we still have excess standby supplies available, and that's with Saudi, UAE, and Kuwait. And if they bring those to the market, that will continue to keep the prices mitigated.
And taking a look at just some of the numbers here, just picking up on the net income number, where you narrowed the annual loss to 30.8 million last year. That was down from a 41.2 million loss in 2022. When will that number be black instead of red?
So I mean, the issue here is we've invested when the prices were higher and the tax rates were much lower. So this is more of an impact of us investing and not being able to return the capital that we've invested in the past. Our cash flows last year was 300 million. Our cash flows the year before were around 500 million. So I think we still have a very healthy cash flow business.
Amjad, thank you so much for coming to see us this morning.
Thank you.
Amjad Basesi with us, the CEO of Enquest. We are counting down to the start of the European trading session, and so far signals are positive, particularly on the FTSE 100, up about 1/3%. As we look to wrap up the quarter, not been a bad one for European markets. Fresh records we've inked across on the benchmark, and we've gained roughly about 7% for the quarter so far.
CNBC. Live ambitiously.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
Bob Geldof sits down for the CNBC conversation.
Well, we did Live 8 in 2005, which was for the Gleneagles in Scotland G8, for Blair's G8. The 7 richest nations and Vladimir Putin sitting down together and agreeing to do something for people who would never know was being done for them, who would never show any gratitude, nothing. There was no upside. I said to Bush once, I said, Mr. President, why don't you talk about this, what America's doing? And he said, Geldof, if I say I built a bridge in Nairobi, they'll just say, why didn't you build it in Nebraska? So there's no upside to this. But can you imagine Xi Jinping, Putin, Erdogan sitting down, just sitting down together and agreeing on anything? What common platform is there?
Live from the New York Stock Exchange, Halftime Report, CNBC.
There's a difference between ambition and greed. Greed is wanting more. Ambition is wanting better, and not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
Feels like a Friday, doesn't it? Anyway, welcome back to Squawk Box, everybody. We're halfway through. Doesn't mean you can change the channel, though, or switch off and go on your holidays, because we've got the headlines for you. Here we go. European equities lining up a session in the green to close out the quarter, following on from a record-high stateside close, even though Fed Governor Christopher Waller downplayed hopes for a rate cut anytime soon.
I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation.
Lloyd's posts its best underwriting results since 2007, with pre-tax profit at more than £10 billion. The chairman, Bruce Carnegie Brown, told CNBC that the macro environment is key to the outlook.
The key message really is that we need to have sufficient capital to pay a growing number of claims coming from a broader range of issues globally, and financial stability is a key tenet of honouring our promise to pay our claims.
UBS cuts the negative goodwill from its rescue of Credit Suisse, leading to a hit of more than $1 billion to 2023's net profit, as the lender warned it might not be able to realise all the expected gains. And Dutch Prime Minister Mark Rutte downplaying trade tensions in a high-stakes Beijing bilateral, telling Chinese President Xi Jinping that chip restrictions aren't targeted.
They are never aimed at one country specific. That we always try to make sure that the impact is limited, is not impacting the supply chain.
InPost full-year adjusted EBITDA jumped 39% on the year, while revenues at the Polish parcel firm increased 25% to 8.9 billion zlotys. Now, parcel volumes jumped 20%, with the firm forecasting stable growth across all key markets this year. And joining us now is Michael Ross, who is the CEO of InPost. Thank you very much for joining us, Michael. Just looking at the volumes that you've got through the business in the final quarter, volumes up reached 175.4 million parcels, up 17%. I can see that has now outpaced the broader market volume. So it feels as though you're gaining market share here.
Yeah, absolutely. Good morning, Karen. Good morning, Mandy. I think really that is at the core of our strategy right now, is really to take market share in all the key markets we're operating within. We see the clear headwinds in the market in terms of cost, consumer change around sustainability, and really the convenience of what our solution is providing in all the markets we're operating within, against what is a legacy to door incumbent operation in most of the markets. So clearly we're seeing market growth, market share gains, and really continue to see that in the forward-looking picture.
Break out the UK for us too, because looking at the numbers, you successfully delivered 17.2 million parcels, up 169% year over year. How much of this was new business in terms of those increases?
It's a combination of factors. I think UK has been a tremendous success story for the company in the last 12 months. A critical enabler for us in the middle of the year was bringing on a new logistics solution, where we made an investment into a partner with Menzies to really bring new capacity to the UK market, which has been quite critical to unlock that opportunity. I think today really it's a combination of both new business and existing business growth, because we had a capacity constraint, and really the UK has really doubled in volumes. We've also seen user growth grow to about 3 million users in total, and the estate itself is now over 7,000 locations, which is really the #1 leading locker solution in the UK today.
Michael, Mandy jumping in here. Royal Mail here in the UK, I believe, is also introducing those parcel lockers around the country, and it's quite sad for the postal workers, though. Are you concerned about that being competition for you?
No, I think, look, the out-of-home market in the UK is still massively underpenetrated. There's significant opportunity for really disrupting this sort of legacy to door business. I think we're well still in single-digit market opportunity. Clearly, it's an infrastructure build and a first-mover advantage build. If you look at sort of where we are today at over 7,000 locations, Mandy, I think the nearest competitor, probably in terms of similar type of model, would be Amazon at just over about 5,000 locations, and then the rest are sort of still in the hundreds, is probably what we sort of estimate. So, great to see competition come into the market. Great to see sort of Royal Mail, who is a partner of ours today, by the way, bring sort of lockers to the market. And we just see it as good news, because really it's just advocating what we've already identified sort of as the future sort of path for delivery.
So give us a pulse check in the markets that you do operate in, Michael. Where would you be looking to see the strongest parcel volume growth? Where would you be looking to see the laggards?
And sort of where you see, look at the markets we operate today in terms of UK, France, Spain, Italy, Poland, obviously. I think really today we're the only really leading out-of-home player in all those markets. Many of sort of the competition have come to market and said they're going to operate in lockers, but really at this point we haven't really seen this sort of footprint develop that sort of others have made headlines towards. I think it's clearly a capital-intensive business. And, it's at the core of what we do, not just one part of what maybe someone else's operation is. So, still, it's a very early market opportunity. You take a market like France, in the last 12 months, we've seen tremendous growth in what we call our B2C business. That's been a core opportunity of growth. We've underpenetrated that segment. Again, like the UK, France has been a heavy to-door business in B2C, albeit out-of-home is more developed in the French market. In terms of user growth. And what we've seen is sort of in the last 2 quarters, sort of 20 to 30% growth in our B2C business there alone as really merchants start to onboard lockers as an alternative form of delivery.
Michael, I just wanted to get into the idea of lockers as well, and how it fits into the context of delivery. And we know click and collect has been a feature for a lot of big e-commerce players for a while now. I had an option to use a locker yesterday to return a parcel and decided it was not really the most convenient option. Who's using lockers? Where is the growth? And is this just a way to take down costs for the industry?
You just really nailed it. I think there's probably a number of factors here at play. Firstly is really the cost to serve of our model. Clearly, we're consolidating delivery into a single location. So we're really trying to optimize sort of the first and last mile of the courier journey, rather than maybe sort of sending a driver down to do 7 deliveries. We're sending it to a single location. That is still today probably the single biggest cost of that parcel journey. I think the second element is the sustainability element. So clearly, if we're converting and really delivering to a single location, the studies that we have done has sort of removed about 98% of the carbon emissions of what you would typically see in a to-door delivery. And clearly there's a consumer angle there, and as well as a merchant angle there. And then the final element is clearly just overall inflation within the sector is clearly driving the need to find cost alternatives as well as consumer-friendly alternatives. And really, well, that's where we see the opportunity for continued growth.
Right. Michael, the story you're spelling out is one of disrupting the delivery market to an extent. But what does the underlying volume look like at this stage? Because the narrative is that customers becoming a little bit more challenged, spending a little bit less at this point and changing those behaviours. Is that coming through when you look at the parcel market?
Yeah, look, I think it's a different picture across Europe, but there's a general trend. The market is probably in low single digits. It's definitely post its COVID boom. If you look at markets like France, actually probably even a negative decline in certain elements. UK probably the most buoyant in low to single digit growth. Markets like Poland are going through an economic boost, so actually they're quite in double digit growth. But generally as a rule, it's, there is challenges in the market. It's been tough conditions, and that's also been a key driver of the adoption of our model, both for merchants and consumers.
Michael, thank you very much for joining us today on the Back of Numbers. Michael Rouse with us, CEO of InPost. Arabile, I'm going to toss it over to you for markets.
Yeah, very quick look at this market picture then out of Asia. We're seeing some negativity, particularly out of the Japanese market then. So the Nikkei is down significantly, 1.5%. So a big drop off there. Of course, that 40,000 point mark was a key level that we had reached as well in this first quarter, having seen initially some big gains. The Nikkei actually managing to rise 20% then in the first 3 months of this year. So a significant riser, perhaps getting a bit of a pullback there. Overall, though, the rest of the market across Asia is actually on the up, with the Australian index actually reaching a record high there on the back of mining stocks. BHP, Rio Tinto, both more than 1% higher. We do have auto news, though, out of China, specifically then focusing in on a company, on Toyota, should I say, then where they say that their sales out of China dropped 36%. So a 7% drop overall then for the company. On to Europe then. Yesterday we managed to close out a little bit higher across Europe's trading picture. We are, of course, looking out for that PCE data tomorrow out of the United States, but more inflation data out of Europe. France, as well as Italy, said to put out their inflation numbers. So we'll look towards that. Overall, the market picture does look to be headed just a little bit higher as we open up trade there in around 20 minutes' time, Karen.
Arabile, thank you. Well, UBS says it made less money than first thought on its acquisition of Credit Suisse, decreasing its net profit attributable to shareholders by $1.2 billion for 2023, with the lender warning it might not be able to realise all the gains it had expected. In a shareholder letter, the Swiss banking giant said CEO Sergio Motti is open to extending his tenure at the top of the company and the integration of the failed bank. Let's get to Sylvia for more. Sylvia, so Sergio Motti saying I'm available to stay for longer, but I think the headline here as we talk about the company, what we know is that it effectively scooped up Credit Suisse for a bargain. Now the narrative today is that wasn't as great a bargain as we thought it was.
Well, we knew this was going to be always a very complex project, really, and that this is just the start of this integration process. So let me break down some of the revised numbers that we just obtained this morning from UBS. In essence, they're saying that their net profit attributable to shareholders was $27.8 billion for 2023, down from $29 billion. The CET1 ratio is also being revised to 14.4% from 14.5%. And all of this off of the back of the revision in terms of negative goodwill from this Credit Suisse acquisition, which now sits at $27.7 billion US. Now, these numbers are important because this is a massive, as I said, project for Credit Suisse in the sense that they have been, there's concerns about them being too big to fail from now on. However, they have addressed some of the lessons that they said they have learned in the wake of this acquisition. They said that their size is fit for purpose, so addressing those concerns of potentially being too big of a bank. And they also said that the reason why Credit Suisse collapsed was not because of a lack of a lack of capital, I should say. So they are addressing some of the ongoing concerns and question marks regarding this integration of Credit Suisse. But the key line that we got from UBS is that the integration is on pace to be completed by 2026. And it's with that in mind that I want to show you this comment that we got from Sergio Motti back at the full year results when we were in Switzerland. And he highlighted really that when you look at this ongoing process, the key risk is delays.
Nothing has really changed. The biggest risk is delays, is time. It's not necessarily if we do it, because we will do it, and are we able to do it on time? Are we able to deliver the mergers of the operating companies on time, and which, for example, 2024 is a pivotal year in that sense because we are merging in the first half of the year our two parent company. We are merging the US operation, we are merging the Swiss operations, and this will allow us to then start to realize the synergies. The IT migration is the second major potential problem, but we have a very concrete plan.
Now, we also obtained some numbers in terms of compensation levels, and also interesting to look at those regarding the compensation for Sergio Motti, the CEO. He is picking up 14.4 million Swiss francs in 2023, and overall the compensation for the management team has actually increased from 2022. And it's also important to keep in mind that indeed in the letter to the shareholders, it says that Sergio Motti is going to remain CEO at least until the end of this integration process, but he is also available to stay beyond that level of 2026. So let's see what's going to happen next. But the key line here is that this is just the beginning of what is likely to be a very difficult process.
So it'll be interesting to see how the stock reacts today, because not getting as much of the cost savings out as anticipated. Don't forget the stock price has been on somewhat of a tear thanks to the realization of the gains on the back of the Credit Suisse transaction. If there's disappointment today, that does beg the question around some of the compensation that's been paid out to the board and to Motti.
Totally, and some of the earlier alerts do suggest that shares are called lower at open. Let's see how that will actually take place. But indeed, we know that when looking at UBS, it's very interesting banking picture, Europe, changing rates and so on, the narratives. But looking at UBS, it is a very interesting story because of this integration process. And there's a lot on the line here for the bank and for Sergio Motti, returning, I should say, to the bank just to save it really amid this integration process. Can they succeed? Looking at what they're saying today, they are on track to complete it. But let's see, because as the CEO said, said this is a complicated process.
Thank you very much, Sylvia. Shares up about what, 62% over the past 12 months? Very good performance. We'll see.
Well, we'll see today. Let's see what the market's saying.
Coming up on the show, we've got a lot of information coming out of China at the moment. We're going to be talking about Chinese President Xi Jinping striking a collaborative tone on US relations as the Boao Forum continues in China. But also we've got some breaking news that Australian wine tariffs, as we expected, have now been banned and binned rather.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 26 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Interactive Brokers pays up to 4.83% on instantly available US dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 4.83% on uninvested, instantly available US dollars in your brokerage account. The best informed investors choose Interactive Brokers.
CNBC. Live ambitiously.
The best advice I can give someone starting off a career is don't have a career, have lots of careers. Try loads of different things. You may start off as a biochemist, but want to be a TV anchor. Try lots of different things. Then you'll find out what you like the most and what you're best at. Before I was a CNBC anchor, I was a trader in the city for 11 years, trading all kinds of financial products. I think CNBC viewers are ambitious. Clearly, by watching the show, by watching the channel, they want to improve their lot, improve the lot of those around them as well.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
It's his first sit-down interview since becoming Qatar Airways CEO.
It's a new era. It is Qatar 2.0.
Bada Almir talks strategy.
Growing in certain markets is very important for us.
Known for its business class, it's now getting into first.
We see that there is always very high demand on first class. I feel nobody can develop first class cabin better than us.
That's coming up on the CNBC Conversation.
Chinese President Xi Jinping warned visiting Dutch Prime Minister Mark Rutte against decoupling and breaking links with China. This comes after the Netherlands blocked chip maker ASML from exporting its advanced DUV tool lines to China, with questions now surrounding whether The Hague will allow it to service the equipment it's already sold. We're talking about billions of dollars here. Xi told Rutte that attempts to restrict Beijing's access to technology will not stop the country's development. Well, Rutte, for his part, said he hoped that restricting access to technology does not impact economic relations with China.
When it is about our semicon sector and companies like ASML, that when we have to take measures, that they are never aimed at one country specific, that we always try to make sure that the impact is limited, is not impacting the supply chain. Therefore is not impacting, let's say, the overall economic relationship.
US Treasury Secretary Janet Yellen has warned China against flooding global markets with a glut of heavily subsidized green energy exports. Yellen warned it would risk destabilizing global supply chains of developing industries. The comments come as Xi Jinping met with American CEOs in Beijing and before her own visit next month. President Xi struck a collaborative tone when talking about China's relationship with the United States.
We are conducting exchanges and promoting cooperation, and our activities are injecting positive energy into China-US ties. How are the relations between China and the United States, and whether the two countries are in cooperation or confrontation, bear on the well-being of their two peoples and the future and destiny of mankind. The respective successes of China and the US are opportunities for each other. As long as both sides regard each other as partners, respect each other, live in peace and cooperate for win-win results, China-US relations will become better.
Leaders from across the globe have been meeting at the Boan Forum, with financial cooperation, climate change and AI taking centre stage. Let's get out to Lin Lin, who joins us now from the event. Lin, we could see a lot of recognisable faces as we did that pan across the room from private equity to the technology universe, which tells you that the détente between the United States and China has made progress in recent months. But the big question mark dangling is what happens from here with the politics stateside later this year.
Exactly, Karen. And, you know, I was just listening to some of those other stories that you guys were talking about. And certainly we are seeing these positive signals coming through from Beijing in the last few days, starting off from that China Development Forum. But there are still major geopolitical tensions that remain. Just a couple of days ago, China announcing that it had filed a complaint to the WTO in relation to the Inflation Reduction Act, saying that it is discriminatory and that it affects the supply chains there in a discriminatory manner. So that is an example of that. Also, what Janet Yellen was talking about in terms of the overcapacity issues. Now, that is already having an impact domestically within China as well. If you look in terms of the solar industry, for example, LONGi, which is the biggest solar manufacturer in the world, recently announced a cut in terms of its headcount because it was cited that it had suppressed margins and increasing competition. But of course, what does that mean for local industries from countries all around the world? We had also recently Brazil announcing that it was launching an anti-dumping investigation into Chinese imported industrial products. And of course, Brazil is not part of the West. Brazil is part of the so-called Global South, as well as the BRICS as well. So these are all sort of factors at play here. And, you know, that I guess the proof will be in the pudding, because recently we spoke with Stephen Roach. He was at the China Development Forum, and he said that what US businesses in particular will be looking for is the action at the ground level. Explicit action were his words. Now, earlier today at the Boao Forum, we had the keynote speech. We heard from the third in charge of the government, Zhao Lijie, and he emphasized three key points. First of all, that he was confident about China's economy, that China will reach that 5% this year and help to push up global growth. An emphasis in terms of wanting to get that foreign investment back into the country, as well as saying that China is against these protectionist policies that have been coming through, and also this bloc mentality. Now, while I've been here, I've also been able to speak with the president of the Asian Infrastructure Investment Bank, Jing Li Qun. Let's take a listen to what he had to say.
We had, I think, very interesting and productive dialogue between the U.S. and Chinese, we call it business roundtable, but they are not exclusively business people. We have academics, both sides, and I'm representing international institution. I think more or less the same. How could the United States and China work together to address the common challenge, climate change? How can we deal with the AI era? How could we regulate, and by working together? So I think the general sentiment is the American business people, academics, the Chinese counterparts all agree there's great scope for cooperation between the United States and China. And my personal view is, even though the United States is not a member of this bank, we worked very well with the World Bank Group, with the ADB. So this means there are great opportunities for work together to live up to the expectations of our people.
So certainly one of the, I think, big takeaways from the Boao Forum in terms of a lot of the discussion panels that have been going on and roundtables is this focus on bringing back that cooperation. And that is certainly something that we heard from Beijing and from Zhao Lijie in his speech earlier today, Mandy.
Very good news. We've been anticipating it. It's been much flagged, but here it finally is occurring with China lifting those incredibly punitive tariffs that essentially killed the wine export industry to China. And those tariffs are coming off today, your time, the 29th of March.
Yeah, exactly. And some breaking news just before for Australia, the Easter long weekend. And as you say, this was long anticipated, but they were, as you say, really killing the wine industry in Australia. They were more than 200%. And it sent, of course, wine sales to China absolutely plummeting in the last few years. In terms of the context here, of course, China brought in a lot of these tariffs, not only in relation to wine, but also beef, lobster and barley and so forth. After the then Prime Minister, Scott Morrison, he had called for an investigation into the origins of COVID-19. And of course, during this period of time, you've had the Australian government saying that some of these tariffs are effectively economic coercion. But since then, since we've had the new Labor government under Anthony Albanese, certainly the relationship has stabilised. But much like the US relationship, there are still tensions because, you know, when we look at alliances like AUKUS, like Quad, they might not name China in their documents, but certainly they are designed to protect interests and protect the, free and open Indo-Pacific, for example, as well. And in terms of the tariffs, we are still, of course, the wine has gone away, but we are still waiting in terms of lobster, I believe, and beef as well.
That's right. And it is the 28th. I apologise. I'm discombobulated because it's a shortened trading week. And I'm
popping that cork too early, Mandy. The market open is almost here. We're bringing the numbers shortly.
CNBC. Live ambitiously.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate.
Scott Wapner from the NYSE. Closing bell. CNBC.
Have you ever wondered if you're being watched?
Nothing looks out of place.
It's a feeling that's creeping in for more travelers as stories of hidden cameras in hotel rooms, house rentals, cruise ships, even airplane bathrooms continue to make headlines. Spy cams were once the stuff of international espionage. Now, anyone can buy these items, either in stores or online.
But how hard is it to find these cameras? And do devices designed to locate hidden cameras really work? We're going to find out.
We asked a Singapore tech company, OMG Solutions, to hide cameras in 3 rooms in this house. Then we sent in my colleague Victor to see how many he could find.
Well, this looks like any other room.
Here's what we uncovered.
I've worked very hard and visualized my success. Trust me, it is a very powerful tool. Ambition to me is not only about making money, it's really about taking those small steps towards progress in life. Every viewer coming to CNBC is ambitious. A homemaker like my mom who has a burning entrepreneurial desire, or it's a trader at a bulge bracket bank. If you understand the story behind the numbers, it can change your life forever.
At the crossroads of better health and better looks, these diabetes drugs are sparking incredible weight loss.
We've never had a treatment this effective that didn't involve an operation.
CNBC goes inside this high-profile, high-demand phenomenon.
It is a game changer.
Unveiling huge potential and hidden risks.
I have more questions than I have answers.
I think we probably will unmask more safety issues.
Big Shot, the Ozempic revolution. CNBC.
European stock markets are open for trade, and don't forget we're coming up against a long weekend, so we may see a little bit of caution in this market. What we've seen so far over the course of this trading week, we've marched higher slightly by about 0.4% on the benchmark. That said, we are in record territory, so we've just been inching towards fresh records of a day, and we've seen it across on the DAX in particular. Another fresh all-time highs. We wrapped up the trade yesterday as we begin the session today. The hand over there. In terms of the French market, fresh all-time highs in session yesterday as well. So again, from these levels that we are now trying to inch further into peak territory, it is proving a little bit difficult to find that momentum, but it has been a stronger backdrop for the quarter. No doubt 10% up for the German stock market, 14.5% for Italian names. So very strong run so far this year. And as we get going this morning ahead of the long weekend for Easter, you can see the market just inching again further into the green. In the context of what we've got underlying this market, let's just see where some of that green is falling at a sector level, various different parts of this market as we get going. Basic resources at the top, that's where the green arrow is felt. And in fact, a lot of green behind me, so fairly broad-based sweep positive this morning. Some weaker areas, construction that is down by just over 1/3%. Insurance names, we just heard out of Lloyd's of London this morning around some of the very strong conditions it's been witnessing and how that's propelled the company forward. But insurance stocks are a little bit weaker this morning. Industrials too, just settling down by about 1/10%. But from there, we've got media names moving green, autos bouncing. Renault, one of the better performers, along with Porsche. Utilities trade stronger. Ørsted right at the top. Banking names, Sabadell, Barclays, BNPS, Lloyd's, some of the early movers to the upside. Chemicals, telcos, all in the green this morning, along with oil and gas up more than 0.4%. And Enquest was a company we're talking to today on the back of numbers. Real estate stronger. Household goods are marching higher by 0.6%. Interesting for this sector. Don't forget luxury had somewhat of a mare thanks to the Kering warning, the owner of Gucci this month. But don't forget we might have a little bit of end of month, end of quarter buying or window dressing this morning as a feature of this market. And that jumps out as we take a look at household goods. Retail stocks up just over 0.5%, and basic resources still taking out the top spot. So somewhat of a cyclical bent to this market this morning. Let's see what that's doing for the FTSE as we see a 0.75% high for that basket. It is helping again move the needle on the FTSE 100 that has actually tried to keep pace over the course of the quarter. We've been up close to 7% for the month, more than 3.5%. So this is territory that is unusual for the FTSE. We haven't held this level even above 7,800 for very long, but 7,954, and we're going for the 8,000 mark. That would be the next step. So that is a very strong start. We're outpacing French names. And again, I mentioned the records we've seen on French stocks and on German names recently. So again, as we put on more green, we keep on entering into fresh record territory. The SMI, a solid start today, outpacing Italian names. Weakest of the bunch, really the IBEX today, showing us a little bit of slippage out of the Spanish stock market. Let's get to UBS and the signals we're seeing out of the Swiss lender. Not much. In fact, despite a fairly significant update this morning, UBS says it made less money than it first thought on its acquisition of Credit Suisse, decreasing its net profit attributable to shareholders by $1.2 billion for 2023. With the lender warning it might not be able to realise all the gains it had expected. In a shareholder letter, the Swiss banking giant said CEO Sergio Motti is open to extending his tenure at the top to see in the integration of the failed bank. Sylvia, I've got to say, this is a fairly positive reaction to what I thought was a lot of downbeat news this morning from UBS.
It seems the investors are more focused on the key question when looking at UBS, which is the pace of the integration of Credit Suisse. And when it comes to that, essentially, UBS has reiterated the plan to complete that integration by 2026. So investors perhaps looking more at that point of this announcement from UBS this morning rather than some of the updated numbers. Now, with that in mind, I also want to draw your attention to the fact that UBS has chosen to use this shareholder shareholder letter to essentially set the record straight. They are essentially saying that the collapse of Credit Suisse was not due to a lack of capital. They essentially say that both banks, UBS and Credit Suisse, were under the same supervisory rules and all the other regulations. However, they were able to rescue Credit Suisse. So this is also in the context of what's likely to happen in Switzerland. We have regulators and lawmakers looking at whether to step up regulation in the banking system as well. But at this occasion, we are hearing UBS essentially setting the record straight, saying that this was essentially an isolated case. Now, we also got numbers in terms of compensation. Always interesting to look at those. In terms of what the compensation is for Sergio Ermotti, the CEO, he is picking up 14.4 million Swiss francs for the year 2023. That is pretty much in line what he had received back in the day when he was CEO of UBS as well. But overall, the pool for compensation at UBS was about 14% lower than in 2022, Karen.
Sylvia, thank you very much for that. JD Sports opening up for trade this morning, and look at that, the bounce, 15-odd%. But I'm just going to take you quickly to what we're seeing out of the overall performance for the stock. There have been a lot of gyrations worth noting, very strong into year-end last year when we had that market rally, but then a fairly steep drop-off amid some concerns about just what we're seeing. And this is a company that's been very positive in the narrative in recent times, but it was seeing some impact in terms of the consumer in recent months. So the latest, JD Sports says it continues to see a challenging market after reporting 3.6% sales growth last year. The sportswear company said trading this year is in line with expectations, with improvement expected later in 2024 due to a busy summer of sports. So the reaction to the numbers stronger today. Let's get to InPost. Its first year adjusted EBITDA jumped 39% on the year, while revenues at the Polish parcel firm increased 25% to 8.9 billion zlotys. Parcel volume jumped 20%, with the firm forecasting stable growth across all key markets this year. Slippage in the stock today. The InPost CEO, Michael Rouse, said the UK market has boosted the business.
UK has been a tremendous success story for the company in the last 12 months. A critical enabler for us in the middle of the year was bringing on a new logistics solution where we made an investment into a partner with Menzies to really bring new capacity to the UK market, which has been quite critical to unlock that opportunity. I think today really it's a combination of both new business and existing business growth because we had a capacity constraint, and really the UK has really doubled in volumes. We've also seen user growth grow to about 3 million users in total, and the estate itself is now over 7,000 locations, which is really the #1 leading locker solution in the UK today.
A big drop in Casino shares that have resumed trading after the firm's financial restructuring was completed, a plunge of 34%. The changes come after months of turmoil for the French supermarket that see a consortium led by Czech billionaire Daniel Kretinsky take control of the firm. Mandy.
Come and sit down, Karen. Let's have a little chat with Lindsay James, investment strategist with Quilter right now on the phone. Lindsay, thank you so much for joining us today. You know, another day, another central banker pushes back against all the hopes, dreams and expectations of cuts coming from central banks that the markets are harbouring right now. Would you agree that we can afford more patience when it comes to monetary easing?
Yes, I think personally, I was very surprised actually in the most recent meeting from the Fed to hear that they were more relaxed really on the recent inflation prints that we've seen coming through. To me, we've had 2 months now of slightly hotter than expected month-on-month core inflation readings. And I think if we get another 2 months of that, and we'll have 2 more data readings coming through before that June meeting, I think it gets more difficult really for them to justify that first cut coming as early as June. Now, of course, closer to home in the UK, we've seen a little bit more progress coming through recently on inflation. And we're going to have that again with April because the energy price cap will start to hit those figures. And that, I think, will make it a little bit easier for moves to start maybe a little bit sooner from the Bank of England and potentially as well from the Eurozone.
So on the subject of stocks, the reaction in the equity markets has been really interesting, isn't it, to the pushback that we've seen from central bankers. And either the stock market doesn't want to know, doesn't want to listen, and it's like, you know, just on its own program and momentum has taken hold and animal spirits are galloping around, Or they're like, okay, maybe it's because the economy is resilient and that is naturally something that would be a very positive trickle down to earnings.
That's exactly it. So, of course, last year, every time there was talk about higher for longer, the market was fairly weak as a response. But this year, it's been really different. And I think there's been a few reasons for that. It is the economic resilience, but it's really staggering data, actually, that we've seen coming through. When you look at those US GDP figures for Q4 coming in at an annualized rate of 3.3%, economists were looking for 1.8%. So there wasn't just a little gap between the momentum in the economy and expectations. It was really quite sizable. And then we've seen, of course, the Fed pushing up their expectations for growth in the year ahead too. We've had strong data out on labour productivity as well in the US. And that's something I think that could be quite sustainable. It looks like companies there are really exploiting some of the changes coming through in the economy, embracing remote working, for example, using the new tools at their disposal in AI. And I think that's going to put pressure on the UK and Europe to respond, but I think that's going to be a challenge. And we've had a very strong earnings season too. When I look back at the first quarter, the biggest move in the US markets was, of course, the day after NVIDIA released its very strong earnings results post-market. So the Mag 7 are really still driving the market at the moment. But I think we're seeing that 12-month, 24-month earnings forecast figure shifting upwards, and that's a positive sign. I think that the performance should broaden out too. So we are relatively optimistic in our positioning at the moment.
For many years, the market looked at the Dow Transports Index as an indicator for markets. And despite a lot of analysts ratcheting up a year-end forecast for the S&P 500 and other major indices because they've already hit targets early, the Dow Jones Transport's performance has been very stilted for the quarter, up less than 1%, for the month up about 1.2% and barely up for the week. Is that signalling anything to the markets about what lies ahead?
Well, I think we need to remember that the strength that we're witnessing at the aggregate level in the US economy doesn't necessarily make itself felt in every sector and every part of it. We still do see a smattering of weaker data signals when you look at things like credit card delinquencies, some of the figures out from some of the sort of lower end retailers as well. And of course, we've had weaker retail sales figures in the last couple of months too. And we've got some uncertainty out there in global supply chains. When I think about energy security, really there isn't any at the moment. It's held in such fine balance that disruptions that we've seen, Red Sea, for example, and the latest impact potentially in Baltimore could start to have an impact as well. So I think there's just this sense that yes, things are going well, but it's a little bit of a sort of a precarious piece, if you like. We've got risks on the horizon, we've got elections coming up, and we've got supply chains that are still quite stressed. So I think that's the reason why we haven't seen that strong performance in every corner of the market.
Lindsay, looking at the way you allocated over the time frame, you say you kept your equity exposure at or close to neutral across the portfolio range because of the risks. Do you wish you had actually been overweight equities given the performance we've had so far?
Well, hindsight is a lovely thing, isn't it? But, as I said, we do see some risks still out there in the market. So clearly, the overall shape of the economy is pretty good. We've got real rates likely to be falling over the next couple of years now. So that's a positive overall backdrop. But when I look at European equities, for example, yes, the valuation argument is very much there for those global stocks that are listed in Europe. But we've got Germany in recession. We've got very weak industrial production figures coming out. They've got structural issues when I look at those energy-intensive industries that have really been the backbone of their export economy. They just can't compete globally with energy prices where they're at. And that's going to be a headwind, I think, for some time. Again, with a potential Trump government coming in, the risk of tariffs on European stocks is still something to consider. And China, of course, has started to perform better, but there's still a huge overhang, I think, in their real estate part of their economy. So there's some good news out there. Of course, we like the US, but again, that concentration in the market does add a certain risk to performance. And for that reason, we're quite comfortable being neutral at the moment.
Really quickly, how great is the concentration risk in the US equity market right now, given that when you take a look at the XLK, the technology fund, it's really gone sideways recently. So I'm wondering whether or not the excitement that has been built into AI and the tech names, the Mag 7 in particular, whether maybe it's running out of steam.
Well, the valuations, I think, do leave a little bit to be desired in some instances, not in every case. But what we're definitely seeing is a broadening out of performance. We've got decent earnings growth coming through across the board. We've been rebalancing a little bit more towards US equity income, so we're looking for that exposure to come outside of the Mag 7. But actually, if you look at the success of the Reddit IPO recently, I think that's quite a positive signal for broader tech. They've been starved of IPOs in recent years, and if that can be kick-started a little bit, then I think we'll see some of that love for AI perhaps being felt a little bit further down the market cap spectrum. And I think there would be some relief amongst global small and mid-cap fund managers to start to see that coming through, but not quite there yet.
Lindsay, thank you so much for joining us. Enjoy the holidays over the weekend. Lindsay James with us, investment strategist at Quilter. Let's push on to earnings reaction. Enquest is trading high, up almost 1.5%. It has beaten on the top line, reporting full-year revenue of $1.5 billion. The UK energy firm reported a smaller annual loss of just over $30 million and announced its first buyback program. The North Sea operator's CEO told the show the firm remains committed to the UK despite the impact of the energy profit levy.
It's reduced the investment and the continuing production in the UK. The production is down from 4.5 million barrels in 2000, but even more exasperated over the last couple of years. Last year is down 20%. We're producing 1.3 million barrels a day, quite significantly down. But more importantly, the investment cadence has gone down very significantly. If you look at 13 and 14, and this is OE UK data, we were investing about 18 to 20 billion in 10 years ago. Last year we invested 4 billion, and that's not adjusting for inflation.
In other earnings news, Lloyds has reported its strongest underwriting profit since 2007, posting £5.9 billion for the year. That is up from £2.6 billion in 2022. The London-based insurer also reported a strong rebound in pre-tax profit to £10.7 billion after reporting a loss in the previous year. We asked the chairman, Bruce Carnegie-Brown, for his take, though, on the bridge collapse that occurred on Tuesday in Baltimore.
We're beginning to deploy resources in anticipation of this being a very substantial claim for the industry and for the Lloyd's market. It's going to take some time for the complexity of the situation to unravel, so very early days to call a number. I don't at this point anticipate that it's outside our realistic disaster scenario planning. It feels like a very substantial loss, potentially the largest ever marine insured loss, but not outside parameters that we plan for.
And here in the UK, Thames Water says shareholders will not provide a planned £500 million of new equity. This is after Britain's biggest water utility failed to agree to future bills and conditions with the country's water regulator. The UK Chancellor of the Exchequer, Jeremy Hunt, says it is his understanding that the company is still solvent and he will monitor the situation. Karen?
Coming up on the show, Dutch Prime Minister Mark Rutte downplays trade tensions in a high-stakes Beijing bilat. We'll bring you the latest next.
We empower those who act, those who see the correlation between predictability and probability, those who manage risk by anticipating each movement, flawless execution, timing, and accuracy. Identify the goal, match power with precision, reach new heights. CME Group, where risk meets opportunity.
CNBC. Live ambitiously.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate.
Tyler Matheson, Kelly Evans, Power Lunch. CNBC.
The climate crisis is a gun to our head. So we better get our act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future, only on CNBC.
Some are calling it a mobility revolution.
We're trying to build a car which can vertically take off and fly efficiently.
The aircraft is composed of 8 arms, and then there are 16 motors and propellers.
We want to revolutionize aviation, make it absolutely zero emission.
It feels pretty incredible. My heart's beating quite fast. It's an amazing experience. We explore the world of eVTOLs only on CNBC Tech, The Edge.
Chinese President Xi Jinping has warned that visiting Dutch Prime Minister Mark Rutte against decoupling and breaking links with China. It comes after the Netherlands blocked chipmaker ASML from exporting its advanced DUV tool lines to China, with questions now surrounding whether The Hague will allow it to service the equipment it has already sold. Xi told Rutte that attempts to restrict Beijing's access to the technology won't stop the country's development. Rutte said he hoped restricting access to technology does not impact economic relations with China.
When it is about our semicon sector and companies like ASML, that when we have to take measures, that they are never aimed at one country specific, that we always try to make sure that the impact is limited, is not impacting the supply chain, and therefore is not impacting, let's say, the overall economic relationship.
Chinese smartphone manufacturer Xiaomi will launch its highly anticipated electric vehicle today, where it will reveal its pricing and start taking orders. Xiaomi announced its foray into EVs 3 years ago, taking on Tesla and BYD at a time of slower growth in the Chinese market. Arjun joins us with more. Arjun, I'm going to take this somewhere we probably don't expect it. To me, if they're successful, it highlights, again, another misstep by Apple. Apple scrambled to catch up when it comes to AI, has reportedly ditched its EV or its car intentions. And what we're talking about here is the largest connected device that Apple is not going to be a player in.
Yeah, there certainly could be that. I think one thing to sort of, on the flip side of that, is the Chinese market's a very unique market for EVs versus where Apple likely would have played, which is the US. The Chinese market is a step above many other markets when it comes to EVs. The infrastructure is growing very quickly. There's appetite for these vehicles out there. And Xiaomi, of course, has a very strong brand within the Chinese market. People like their phones, but not only that, what else do they make? Rice cookers, TVs, everything else in between.
All the fun stuff.
All the fun stuff, everything. And this is an extension of that play as well. But certainly, I think if this is successful, Apple will be looking at this thinking, because Apple, of course, has its own very strong brand in China as well. And that, you know, given the fact that Tesla has made a very big impact in the Chinese market and has been very successful there so far, there certainly will be part of Apple thinking, maybe we should have continued on our road there. But EVs are not easy. They're not easy.
Well, like to say, what do you think of the timing, right? Because obviously when they made the announcement back in 2021, we were still very much at the naissance of mass market EV ship. And there was quite a lot of hype in the market. And now we're just, as we were talking about yesterday, we're in desperate need of consolidation. And even the legacy players are finding it difficult and having to cut prices.
I think it's quite impressive how quickly Xiaomi's come to market. Sort of within 3 years, they said, we're going to do this. and they've gone all in on it. Lei Jun, the CEO, had an interesting comment on X, and he said, "This is my final new venture. I'm putting my reputation on the line to fight a vision I deeply believe in." This is a huge gamble for Xiaomi, quite frankly.
Is it a personal thing for him? It's
a personal thing. His vision is that for a long time has been that Xiaomi is going to be this connected device company, and whether that device is a smartphone or whether it's effectively a giant computer on wheels, i.e. the EV, and smart car, it needs to be Xiaomi. And so this is an extension of his vision, but the timing is a tough one, I'd say. Given the fact, as you mentioned, the price wars that are continuing to go on, the price cuts that continue in the Chinese market, still the sort of cautious consumer sentiment within China, these are all headwinds that Xiaomi's coming to market with now. Now, look, I had a chance to look at the car. We saw it at MWC earlier this year. It's a very nice looking car. It's got a strong design. It's very sporty. It's got the Chinese consumer wants technology in the car. It wants the latest technology in your car. That's something no doubt Xiaomi's going to promise when we hear from them later today. And that's going to be a very key selling point of this as well.
That's the other gap that it highlights, just where some of the German autos are as a result. I remember going to one of the motor shows in Germany a few years back, and the message was that, look, they barely have one digital platform, let alone multiple digital platforms for the future. And of course, now here comes AI. So if a company like Xiaomi is going to use all the technology, all the learnings that it's had from a smaller device and roll it out in a bigger device, it does again highlight the challenge for a lot of those German and French European players trying to get into the game as well.
Yeah, and the software. The software is key. Xiaomi just recently launched its own operating system as well, based on Android in China. And the idea is that if it can control the operating system across its devices, it'll be a lot better user experience. Very, very similar to what Apple does, of course, with iOS, and the fact that it's got, CarPlay when you hook your iPhone up to certain cars these days as well. That's a similar kind of thing Xiaomi is looking for. It's very similar to what Huawei is doing as well with its auto ventures and its connected devices as well. This is now becoming something that, and on the flip side, what you've seen is the CarPlay is Neo launching smartphones, knowing that there needs to be this link up to some extent between the device you have on you 24/7 and your car.
Yeah, I do wonder whether that move, though, is one that attracts more attention from a security point of view. Already we've seen some pushback around cars. It's early stages, it feels, but there's been pushback around phones. For instance, whether US workers, US government workers should be taking Chinese phones into some of the government buildings. I mean, if we're talking about an integration here between a Chinese player on the phones with their cars, there could be security implications, right?
Yeah, no doubt. I think that'll be looked at very closely. Of course, the Tesla story is one. Again, they're looking at Tesla, I think government workers, the iPhones as well, all of those things. But in China, I think Xiaomi is a key player there.
Have we crossed the Rubicon in terms of Western markets' acceptance of Chinese cars? I mean, I drive a Chinese car, a Haval, from Great Wall Motor. Haval stands for have value. It's, the car that has value. That's the, the message they want to put out. But remember, like in the late 70s, I think Western markets were a little bit snobbish about Japanese cars. And then in the early 90s, it was Korean cars. And now, absolutely.
I had a Korean car.
Yeah, and Japanese. I've had a Hyundai. I've had a Japanese car.
Oh, yes. But I mean, different markets. I think Europe, a slightly different equation. And whether there is an acceptance over here, and also the US market as well, because of the price point, will be fascinating.
Oh, they're undercutting. So the car that I drive basically looks like a Range Rover. It's Chinese-looking Range Rover, but the price is about half the price of what you'd pay for a Range Rover. So they're undercutting so much to get that market share. But have we crossed the Rubicon? Have we got to that point
and they're going big on the marketing, trying to appeal to a more luxury premium audience, and there's probably a lot of people who just don't know BYD is a Chinese company. There's that. They're not making that very obvious through a lot of their. I think that's on purpose, but they're trying to appeal to. I mean, look at the cars.
Haval sounds French.
Yeah, exactly. I mean,
Haval.
And even the BYD Seal. None of these names sound sort of Chinese in that sense.
Xiaomi might have to change its name.
Might, but they're coming out calling it an SU7. I don't know if they'll ever launch in the international markets or when that plan is, but clearly they're looking for premium. They know that's going to appeal in Europe. Very sporty, very slick-looking cars with some technology in it. Very different to what some of the European autos are offering at this point in time.
And a spicy point in the economic cycle too, when the price may matter to the consumer as well.
Very true.
Arjun, thank you very much. And for more on Xiaomi's big EV play, you can check out Arjun's piece. He's been busy at work on the internet as well. CNBC.com.
Coming up on the show, indeed, we're almost there at the weekend, folks. Fed Governor Christopher Waller pouring cold water on hopes for a rate cut in the market as US equities notch a new record high. We'll bring you all the details.
CNBC. Live ambitiously.
I think ambition creates a pathway. It gives you a purpose in life, and without it, you can drift along. On Squawk Box Europe, we covered 3 hours of live breaking events. It keeps me at the top of my game, having to react instantly to these developing events. You have to do the prep in this job. You have to spend the hours reading in. For me, it's instrumental as a journalist to work hard. I've always wanted to be the best journalist I can be, and it means something being on the best business channel in the world.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays, CNBC.
The UAE government invested more than $20 million in research to start a process called cloud seeding. The UAE performs around 1,000 hours of cloud seeding to enhance rainfall in just 1 year. And it's all controlled in this building, the National Center of Meteorology in Abu Dhabi, where they track the whole process. We met with a cloud seeding expert to explain how the seeding process works.
We wait the forecast when we have a good chance for a cloud. We send the aircraft to that location. Go under the cloud. In the first stage of the cloud, there is good updraft at that time, start to release all the salt, and with the good updraft, of course, it will go inside the cloud. The droplets will become bigger and start to rain.
The center manufactures a salt substance that helps enhance rainfall. They put them in what they call flares.
Scott Wapner from the NYSE. Closing Bell, CNBC.
Jake Gyllenhaal on working with professional fighters.
I was like, so you're not going to hit me? And they were like... So that worried me when I...
Actress Andrea Riseborough and a closer look. New Seth Meyers.
In the headlines today, European equities edge higher to close out the quarter, following a record high stateside, though Fed Governor Christopher Waller downplays hopes for a rate cut anytime soon.
I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut rates will keep the economy on a path to 2% inflation.
Dutch Prime Minister Mark Rutte downplays trade tensions in a high-stakes Beijing bilateral, telling Chinese President Xi Jinping that chip restrictions aren't targeted.
They are never aimed at one country specific. That we always try to make sure that the impact is limited, is not impacting the supply chain.
UBS cuts the negative goodwill from its rescue of Credit Suisse, leading to a hit of more than $1 billion to 2023's net profit, as the lender warns it might not be able to realise all of the expected gains. JD Sports steps to the top of the Stock 600 as it says it expects market conditions to improve in the back half and backs its guidance for the year. Big moves in Reddit shares. They're continuing their slide in pre-market trade after falling sharply yesterday. The move came after research firm Hedgeye Risk Management named it as a short idea with a potential 50% downside. So some question marks out there as to whether it deserved its valuation as a meme stock, which is how it's been trading. Now, expectations of interest rate cuts fueled investor hopes of an M&A rebound in 2024. Arabile has more on whether the first quarter delivered. Arabile.
Well, Karen, we certainly saw a lot of deals coming to the fore then in 2024, and it's been touted as this year where we're going to see some uptick then in this M&A and deal activity, right? We have the interest rates still at those record highs, but the anticipation is that they'll drop off. Maybe that will begin to influence things as well. There is still that strong economy out of the United States, so a lot of question marks around whether North American deal activity will begin to pick up. And so too on the other side, Europe, of course. Some question marks as well around the rest of the world. If you just take a look at this uptick, then you'll see that there has been a slight uptick in the Q1 amount of M&A activity then as well compared to last year. But the question mark is what happens for the remainder of the year. And that's going to be quite critical and important. Which sectors are also going to take in quite a bit of this deal activity there. Just looking at Morgan Stanley's research as well, they predicted that there's going to be a 50% increase in deal volumes compared to 2023. So if that comes to the fore, that certainly will get the market talking. 2023, of course, saw the lowest activity in almost 2 decades. Non-financial companies, as well as private market investors, accumulated a total of $8.1 trillion, that is, in unallocated capital. So is that pent-up demand now going to be spent pretty much in this year? The sectors that we pretty much are seeing with regards to that activity, and this is rather the regions as well that have pushed up when it comes to that. So North America in first quarter taking up the bulk of that deal activity so far then, according to Merger Market. Coming in second place is Europe. So will these two continue to take up the bulk of that deal activity? Speaking of which, you have the likes of Capital One's merger with Discover Financial as well. Big one there. That would challenge Visa and MasterCard overall. You have Walmart buying Vizio. So that's entering the television space. So perhaps a new look on that front. Synopsys buying Ansys as well for $34 billion. So some big moves on that front. Will they continue in that vein? Will that pent-up demand continue to pick things up? North Asia also being quite significant in the amount of deal activity we saw in the first quarter. So what happens then for the remainder of the year, Karen?
Let's try and answer that question, Arabella. Come and join us as we broaden out the conversation with Lucinda Guthrie, who is head of Merger Market. Lucinda, the drought has broken. It was raining buckets, but not a lot of them. By that I mean there's a lot of value in the transactions, not a lot of volume.
Yeah, I mean, it's incredibly interesting that data you just saw from Merger Market with the value up 15%. Most of this is driven by large cap deals, which is obviously why you see the number slip there. We had, the thing that is interesting for me with that large cap activity is that you are seeing corporates getting a bit more appetite to strike those large, riskier transactions. So I feel like that is a direct link to what we were talking about the sentiment from interest rates, you know, potential cuts coming. I feel like that's what's driving the activity, but ultimately we're not seeing the count there yet. So we're not out of the woods yet.
Absolutely isn't it? So balance sheet strength being used. When does it translate for the bankers? Because I gather they don't get paid till the transactions finish. So this could take a little while as well for it to play out for the banking numbers.
Yeah, you've hit the nail on the head. Last year, revenues were down significantly, and this year, in the first quarter, revenues were down 17% according to Merger Market data. Now, what's happening there is, one, you've got these large cap transactions, they're riskier, right? So you have to get regulatory approvals, the complexity of the deal is much more than we've seen previously. And then the other thing to bear in mind, and this is more of a UK thing, is you're seeing quite a few kind of pre-announcements, the 2.4 deals coming out where deals are almost being tested. And some of those obviously aren't going to come through.
Listen, if we talk about the valuations then as well of these deals, I mean, does it tell you that this cycle is as, or could be as big as some of the others? Not necessarily by volume, but just the size of these deals? Or is it just going to be a few bits and bobs, so to speak, and in high volume?
There's two things going on with valuations that I think are really interesting. One is that we obviously had the reset in market conditions from 2022, right? We've had a long period where the bid-ask spread has persisted. Right now, what we're hearing in the market is that some of those valuations, the seller expectations, are starting to come down. So we are starting to see more conversations happening now. So that's one thing that's really important in valuations, and we have seen valuations come down in certain sectors. But the other thing that's happening and this is in the public market space, that, in the UK, for example, is there's a little bit of fear of missing out. So, like with the Wincanton deal, for example, you know, you see a rival bidder coming in 100% premium. I mean, it's like now's the time to act, because there's this relative period of stability, and people don't want to miss out on these fantastic.
Is that the pent-up demand that's then going to be spent up? And I mean, what's the catalyst to get that driving more significantly, as opposed to just having this deal that, you know, you push up and get 100% premium on?
Well, exactly. The driver for the bulk of activity is interest rates.
Yeah.
Obviously, interest rates, there's an expectation that they're going to be further cuts. However, if that doesn't happen, activity is going to dry up just as quickly.
From central bankers that, look, it might not happen, right? So that could see this year actually not look as bright and as rosy as some had projected?
Yeah, I mean, that's the big risk here, right? There is, on the North American side, there's concern over the elections, the impact of the elections. Less so in UK. Everyone I'm speaking to in UK is like, you know, we've already factored in the election risk. So those are the big risks there. I'm cautiously optimistic. What we are hearing in the market is that there are more talks happening on the private equity side. Dreadful year for private equity. I think the exits were down significantly, buyouts were down as well. But we are hearing that people were waiting for full year results before they were doing transactions, again, to help understand valuations. One thing that was also a drag was the kind of creative exits. So people are looking at continuation funds, dividend recaps, instead of, exit through M&A. However, we do feel that there will be a bit more push for exits because people, private equity, need to show returns.
What needs to happen to be able to unleash more private equity transactions and just send better sentiment in that department?
I think for us, that what we were hearing is it was this valuation, the bid-ask spread. So as I said, we're starting to see that coming down. But I really feel strongly interest rates. It's interest rates. That's the main.
In which case, as you said, this relative period of stability could be short-lived.
Exactly.
It's fragile.
Exactly. And the other thing to bear in mind, sounding very negative now, is that we've had this huge, increase